Yeah, I mean, I think we're kind of set up for that at this point. You had a little bit of a positioning destruction last week, which probably helped kind of rebase things a bit. I think if you take the Fed at face value, which is kind of a flattening out unemployment rate, inflation still on a downtrend, getting a couple insurance cuts in there, that's all kind of net positive for equity. So I think your path of least resistance is to the upside to year-end.
It still is. Like, we're not upset too much by what Powell said last week or the fact that we did have a hawkish cut and felt like decidedly so.
Yeah, not too upset. I think really what happened there is the Fed kind of confirmed what was a bullish growth outlook. They sprinkled in a little additional inflation risk. And I think that additional inflation risk is what you traded last week. That kind of worked against what was very long positioning. We think that positioning dynamic has kind of worked itself out. So now we're back to the situation where if we get a nice payrolls report to start next year, I think equities will respond really well.
Okay, so then if we do have some kind of upset, let's just say between now and the end of the year and then into the early part of 25, you'd be a buyer. That's what this sounds like.
Yeah, we're a buyer with the one contingency that employment report on the 10th of January is an extremely important event. But yeah, I think if you got a couple percent pullback here, I think you are a buyer of that dip, and then you're kind of read and react to the data as it comes in.
When you say, that data point is critical, I mean, how are you gaming that out? What makes it so critically important?
I think what makes it important is the Fed is telling you we think the unemployment rate is going to stabilize around these levels, and that's why we're able to kind of reduce the number of cuts we're going to do, next year. If you get an upside surprise in that employment data, that's equity negative, full stop, because your growth data is weakening. But that probably then puts the Fed in play to do more cuts later in the year. So we do think it kind of plays into a key part of their economic projection.
I mean, that would introduce just more risk of being forced to do more cuts, potentially at a time where we're thinking we may get reinflation from some of the policies in D.C. and the new administration.
No, I agree with you. I think there's a case to be made that in the first half of next year, the Fed could be in a really uncomfortable spot, right, where you have unemployment rate rising, the government efficiency kind of trying to stop federal hiring, which has been a big part of the jobs growth, and then you get tariffs, which kind of push inflation a little bit higher. So there is a scenario there where the Fed kind of gets caught between a rock and a hard place, without a doubt.
What does the market look like, do you think, next year? We're ending in a place that's made people a little bit uncomfortable, right? We're back top heavy. How does next year look?
Look, I think risk reward is tough going into next year in the sense you have a very high EPS growth forecast. You have very extended valuations. So to your point, any bad news is going to kind of not be welcomed and actually punished pretty severely. That said, if the unemployment rate flattens out and you generate that earnings growth, then equity should kind of be up, a modest number. You wouldn't expect it to be 20% plus. I think, let's call it earnings growth as mid-teens. So you're probably playing for something in the 10 to 15% range. Best case. Worst case, you have something that looks like 2018, let's say, where you kind of had underlying decent data, but you had a couple really big pullbacks because of the risk environment you were living in.
But what does the makeup of that look like? I mean, if rates, let's say, remain elevated, you get fewer cuts, and maybe it's partly on the jobs report. The broadening story is built on strong economy and rates coming down. Anything that upsets that throws all that out of whack.
Yeah, no, I agree with you 100%. I mean, if you believe we're going back to the higher for longer narrative, that was the first half of 2024, right? And what did well then? Your large cap, your growth, your kind of safer stocks, right? What started to cause the rotation? To your point, during the summer, we actually got a broadening out of EPS growth. The 493 actually generated positive EPS, and we got a nice rally in broadening out. So next year, the earnings are set up for broadening. The question is, do we realize that? So that's going to be the ultimate test, I think, for next year is do we get the broadening out in EPS that we started in 3Q? Does that follow through into 2025?
Would that be the way that you would invest in the market? You would, maybe take a little bit off of the idea that mega caps are going to have this outperformance yet again and then play for the broadening that we're debating here?
Yeah, to me, your core position right now should still be in that higher for longer sort of situation because that's what the Fed is telling you is going to happen. And I think that needs to be your base case. So I still think you have some discretionary telecom services and tech as a core position. And then, do you want to sprinkle around some broadening? Yes. The trouble with that broadening trade, I think you alluded to it, is if you get weak economic data, that broadening trade just falls apart immediately. So you need to be kind of very careful about how you broaden out. Otherwise, you kind of, open yourselves up to a big risk. So I think your core position is, call it large cap growth as a core position, and then you're kind of sprinkling on some risk, some risk in that broadening story. But I think you need to be very careful with that risk, in my opinion. Yeah.
Okay, we'll leave it there. Stuart, thank you.